Welcome to episode 64 of Accessible Finance. Let's dive in.
All right. So like we discussed at the end of episode 63, there was a really interesting thread conversation that was taking place in one of the groups that I'm on, where the prompt said, give your younger self financial advice that would have benefited you today if you knew better or had listened. So I have written some of the stuff that's here, and I'm going to have you weigh in on agree, disagree.
Huh?
Okay. Or any thoughts. Again, just so that you guys are aware, this is not like a Yahoo like crowdsourcing thing. It's most certainly like people who are very involved in financial matters. So the group of people who are weighing in here are pretty knowledgeable. Okay. So number one, do not buy those gold and silver coins.
There's a lot of truth to that. One of the things that's overlooked, not even just do you buy commodities, but there is a significant cost of doing business, right? So cost of selling the gold or silver. Even if you did think that gold or silver was going to beat the S&P or whatever you thought it was going to do, or help hedge against like equity underperformance in certain down markets, you still have to find a buyer for the gold. And then the gold buyer has to verify the authenticity of the actual piece of, what do they call them? Something? I can't remember. Is that it? I don't remember, but there's a name for the actual.
We have.
Yeah, there's a name for it.
Yeah.
Anyway, the gold buyer will have to verify it, and then and that all costs money. So anyway, correct. I absolutely agree. Not to mention, this is all not to mention
Krugerrand.
Yeah. Okay. So this is all just separate from the discussion of whether or not the gold
That's a
would have
fair
been
point.
a return that beat the international.
Is that it's not a straight return because you're having out-of-pocket costs in order to be able to sell said good.
Right. Exactly.
Okay. I like it. The next one: invest 10% of everything, even when you think you can't afford it.
I think that's great. I think that's great. It's very difficult to catch up, right? Compound interest is real. Compound returns are real.
Yeah.
So the earlier you can get the money in to start letting, the compound interest do its thing. And
there was a lot of discussion around, I wish I'd told my younger self, like, participate in your retirement plan at your first job, right?
Okay,
like when you're young, it's very easy to think I have time to save later.
Sure. And then
but
you're in your 30s.
Those are the dollars that are the most valuable because they're growing the longest.
Exactly. Every dollar when you're young has much higher value to you than the dollars that you put in your 60s. They have much less time to do work.
Now, this next one, if I was putting tally marks by responses, this one by far and away was the most popular response.
Oh, was it?
Put more money into a Roth.
Absolutely.
That was number one.
Especially when you're talking about giving it to your younger self, right? Salary and earnings potential increases with age. So as you become more experienced and seasoned in your profession, you're going to demand higher wages or, elicit higher wages, right? So you're going to be paid more later. Mm-hmm. You should definitely be paying with after-tax dollars on the front end when your tax rates are lower.
Yeah. And so to that end, somebody replied and said, it wasn't just about putting more money into the Roth. It was like, do that instead of the traditional, because a lot of these people are on the older end, right? They're looking at retirement. It's a retirement group. And so particularly if you're talking, 40 years ago, 30 years ago, like the knowledge around a Roth.
Right.
I mean, it was
much lower than it is today.
Correct. And so the rule of thumb was always, 401k, right? Your traditional retirement plans are best. So there was a lot of that.
Yeah, the Roth options weren't as prevalent back then. They are now, and absolutely, when you're earlier in your career, you can do it.
You can have losses in the guaranteed fund.
Guaranteed fund. What are we talking about?
I don't know. The people who replied and asked them what they meant, the original poster never replied. But I think that my understanding, based on what people were saying, correct, was that people not understanding how inflation and things like that affect what they believed to be a safe bet.
It might even be
a real return.
So we can
even be.
We can have a little brief discussion on fixed income and why bonds are not quite as risk-free as most would have you believe. So even if I buy short-term risk-free government bonds, like 2 years or less, maybe even 1 year or less, government securities, okay? The thought process is, hey, they're paying like 4.5% right now. Let's just round. Paying 4.5%. If I put my $100,000 in there, the most I could ever lose, or like really that I can't lose anything.
Right.
I'm always going to get back $104,500.
Correct. Worst case scenario, I get back exactly what I gave.
Right,
Like, I can't
But
lose
if you're
anything.
in actual bond funds, so like an ETF or a mutual fund that's holding these bonds, if the interest rates go up from here, so if there's unexpected inflation or any other thing, or the economy is overheating, if there are any unexpected changes to the economy that would cause the Fed to raise interest rate, the value of your outstanding bonds would go down, right? And that makes sense if you think about it, because I paid $100,000 when the rate was 4.5%, right? And then if the rate is now 6%, there's no way someone's going to pay me $100,000 for my bond that's paying 4.5%.
When
If
they
they could
could
just
get
go pay $100,000 and get 6%, why would they do that? So I have to discount mine. So the price of my bond goes down because it can no longer sell at face value of the 100,000, because there are now bonds that are selling or yielding much more when you purchase them at face value.
Correct.
So that makes sense. So when the interest rates move up, your price of your fixed income will, all else equal, go down. And it can move quite a lot, especially the longer the term of the bond, the more that price will shift, the longer the duration, they call it, right? So if I have 30-year bonds, they're going to be much more volatile.
Yeah, exactly.
Anyway, so yeah, a lot of people think, safe bet,
Bonds are
sure
safe,
thing, I'm going to be
exactly.
in this bond ETF. And they're not thinking about that. They're also not thinking about the reduction in purchasing power. So
That's where I
inflation
thought
will
you were going.
erode purchasing power over time. And we talk about market risk, and it's very real. We're not trying to understate the risk in equity markets. We're just saying that the risk in fixed income markets and bond markets, and even government bond markets more specifically, is not zero.
Right. All right. The next one was to buy more Bitcoin.
Oh, come on.
I know.
Hindsight's 2020. I'm with as far as I know, most of the big banks and the retail, investors, when you're paying for advice, or when you're paying for financial management and investment advice from large banks and institutions, we're talking like Merrill Lynch, JP Morgan, those kinds of institutions. You're paying because you think that they have the smartest people in the room, and that they're more educated than the rest of us, the rest of the financial, advising community. My point here is, even those guys are like, and especially those guys are like, look, Bitcoin is not real.
Right? I think it's important to differentiate the advice of buying Bitcoin versus, investing in a Roth or saving earlier. Like, the others are uniform best practices in the industry, whereas this is a bet that worked out.
Correct.
For now.
Yeah, it's like saying go back to 2015 and go buy, load up on Nvidia, or go back to the 2000s and load up on Apple or whatever.
Right. Well, exactly.
Just look at which graph went up and to the right the most, and then go buy in that. Like, oh, great, yeah, you won. But the thing is, the rationale here is not we should just outsource our thinking to the larger institutions that are doing investment banking or investing. What the thought process here is that Bitcoin, its fundamental purpose, like we could do a podcast on Bitcoin, right? Its fundamental purpose was to provide an alternative to fiat currency, which is like government-created currency, right? It cannot do that because it does not provide a stable store of value, right? You do not want to enter a restaurant, or it doesn't matter if you want to or not.
The reality is that
economies cannot function when consumers and participants have to enter an institution, right? A restaurant, let's call it in this case, sit down at their table thinking they're going to be paying, let's call it 1 Bitcoin, just because rounding. I know that it's not going to be $100,000 for your meal. I understand. But by the time they could be paying 2, or they could be paying like a quarter of a Bitcoin by the end of that meal, or 10x that, so 10 Bitcoin by the end of that.
Right.
And you have no idea. It's exponentially volatile to the point where, like, if you're going to lunch and it's the trading day, like, Bitcoin could just plummet to the point where you don't even know if you
could actually pay for your meal.
So, that aside from all the other energy inefficiencies and other added funds, illegal or illicit activity.
I knew you'd be excited about your soapbox. But and again, this is a pretty educated group of people. So the post that said to buy Bitcoin, there was a little like winky face afterwards. But I do think that was important to mention. Just because I think that this is something that the general public would be like, it's one of those, man, I wish I would have known.
I know a lot of people that are
for a lot of
sold
stuff
on it.
Correct. All right.
Not as many professionals as just
I think
investors,
that's
particularly the younger generation.
Yes.
Generation Z, as they're called, and lower, are much more, high on Bitcoin than the older crew.
Sure, for sure. Okay, do not use your 401k to buy a house or pay consumer debt.
I like where their head's at.
Yeah.
You're still going to pay taxes. Like, so usually on the qualified distributions, you can avoid the penalty, but you still pay taxes on it. And allowing that money to grow, compounded over time is
Yeah.
going to be more favorable. And typically, if you're borrowing from your 401k to make a down payment or something like that,
Yeah,
you are probably buying too much of a house or buying things that you
exactly.
really
You're
afford.
probably, well, and we'll get to that.
Borrowing from
So this one was
yourself to do
interesting,
things.
and I'm interested in what your feedback is here. Never do a 30-year mortgage, only 15 or less.
Yeah, I don't like that.
I don't either.
Agree.
I like the idea of doing a 30-year mortgage, and then if you have the ability to pay it off in 15, pay it off in 15.
Right.
But again, like in our previous episode, we had someone whose mortgage was 2.75%.
Right. I understand the thought. You're getting out of debt sooner. You're planning on higher payments, and therefore you're going to be budgeting more conservatively, all else equal.
Provided that you're someone who can budget reasonably.
Provided that you're someone who can budget reasonably.
just-
I don't like this as blanket.
I agree.
It might make sense in a variety of situations, but I just don't think. I feel like it's like telling somebody to go all Roth or like go all traditional in their like retirement accounts. Like, yeah, it probably makes sense for a decent amount of people, but not for everybody for sure. I don't like it as blanket advice.
All right, buy as few cars as possible.
Okay. I personally ascribe to this kind of
Sure.
buy a car that's efficient and drive into the ground. I like that personally, but for some people, I don't know that this makes sense. Some people really derive pleasure from driving different cars and variety of vehicles, and for those,
They may even be leasing.
vehicles,
Exactly.
You might actually save money because of the transaction costs of purchasing and selling vehicles.
Correct.
So that makes. I mean, I don't. Again,
I think this one will be your favorite. Stay away from insurance salesmen disguised as financial advisors trying to sell whole life insurance.
boy.
This one had the most upvotes.
Yeah.
So, like I said, the earlier one was to put more money in the Roth. I think that was the comment that got the most posts saying some version of that. This post got the most like thumbs ups or like likes on that.
Sure.
Yeah.
No, absolutely.
And the horror stories are very real.
They are. It's difficult. It's also super difficult to talk people off of the ledge once they're already there.
Yeah.
Once they're in the product.
Well, I think you have a psychological need to legitimize this purchase that you've made for yourself when you know that you're stuck there, right?
Yeah, right. Or that you're at least you're not so much stuck there, but you might lose the benefits that are sold. You don't want to feel like you've just wasted, X amount of years investing in a product rather than like an actual sound investment, and that you've made some erroneous decisions or that you've been conned. Nobody wants to believe that.
Of
about
course.
themselves. Nobody wants to believe themselves to be incapable of making good decisions.
Correct. And the successful insurance salesmen are very likable. They're very kind. You don't want to believe that that nice man that brought you cookies
Right. Was actually
was a jerk
with your jewelry.
Yeah, exactly.
Absolutely correct.
All right, this one's an interesting one. If you can't afford to pay for the car in cash, you can't afford it.
Okay. I
personally ascribe to this.
Ascribe to it.
However,
not always true.
Yeah.
Certainly not always true. There are high earning professions. Just one example is high earning professions. They're going to be saddled with student loan debt. Let's talk about like doctors or somebody entering the medical professional field. They're going to be making maybe $300,000+ immediately, or maybe 250 plus. They're going to have a ton of medical loans, but like they have to commute. So it's not necessarily amazing for them to, like, they can't not get a car. I mean, I guess they could and take like public bus or ride their bike to work or something like that. But that's an extreme solution that might not necessarily make sense.
Correct.
If we just math out what their earnings are and what their actual spending is going to be, it could make a lot of sense.
I agree. And additionally, I think you can also plan for being able to purchase a car in cash. But if something happens to your current car and you need one sooner than later, you can still have a plan for that. And we work with clients doing exactly that.
Correct.
Invest no more than 5% of your total portfolio into any one stock.
I like this. The number can vary, right? Like 5, 10, some would say as high as 20. I think 10 is probably the upper limit that I would want to push, but I like this. I'm happy with this as general advice, particularly if we're talking to younger selves who almost assuredly are not going to have any, advantage over the guys on Wall Street that are doing the picking. So in large institutions, firms, investment banks that are actually doing the analysis on these stocks.
Now, I do think it's interesting when he's, when you say 5%, is that 5% also, including the percentage of your like S&P index funds and stuff that are exposed to that, or are you just
Well,
talking
at this
like
point, you buy those, you might be getting 5% of a company.
exactly. So that's I think is
Yeah.
important for for you to be able, I think, to articulate that when you're talking 10%, when we're talking 10% with clients, we're looking at total exposure
That's a good point.
to a stock,
That's a really
not
good point.
right. It's because it's not like I'm buying 10% of my portfolio in Apple, but then I'm also going to buy a massive amount of like an index fund that is also massively exposed to Apple.
Let's assume, just to be like really clear and to try to drive home the point that Rachel's making, because it's a good one,
Thank you.
is if my portfolio is, let's call it 95% VTI, okay, and then 5% Apple, I don't actually own 5% of Apple because Apple's percentage of VTI, call it maybe 4% or so, all right? I'm actually owning 9% of Apple.
Correct.
Does that make sense? Like, so, well, it would be 95% of 4%. You get the
We're
idea, but we can
close.
round up to like 9.
We could say it's 8
Okay,
and a
so
half.
we own significant. Well, the point, all that needs to be true for this point to be well made is that it's significantly more than the
Than the 5% you think
the
you own.
5% owned,
Correct.
right? Because all these indexes are going to own all the companies at their market cap or their market capitalization, which just means how much their total valuation is worth, right? So
Exactly. I mean, I love the idea of trying to come up with a quantifiable way to identify like this is our upper threshold for what we're comfortable with, you know,
yeah,
in any individual stock. But it's important to understand that you can't just go and look at your ticker for Apple and be like, that's all I
that's
own
what
in
I own in
Apple.
Apple. That's exactly right. No,
Yep.
that's a very good point.
Thanks. All right. If in the lowest tax bracket, invest to the company match, ideally with a Roth.
Okay.
Then max out your Roth IRA.
Yeah.
Then fund your HSA, and then go back to maxing your Roth IRA.
That's interesting. There's a lot there. There's a lot to unpack there. The thing that I would just first say is, again, it's blanket advice. I like it. We're talking about lowest tax bracket, so there's a little bit of a qualifier,
Correct.
and that makes sense.
I think this was the
Particularly
only
if
one
we're
that had.
talking about, this if we're talking lowest tax bracket, are we talking 10%? Like obviously, yeah, you're going all in Roth.
I think they're talking their lowest like lifetime tax bracket, not necessarily
Got
the
it.
lowest tax bracket for per IRS.
Got it. The only thing I would want to discuss there, like, absolutely agree that tax brackets and Roths are going to be, inversely correlated.
Hand
The
in
higher the
hand.
tax bracket, the less desirable Roth is. The lower
Sure.
the tax bracket, the more desirable Roth is, all else equal. The only thing that I wanted to speak to you real quick is an HSA. What kind of financial situations make sense for an HSA to be viable, right? You want a significant amount of taxable savings. You want a significant cash flow, right? Where you can afford to pay out of pocket, since you got a high deductible health plan for HSA eligibility. You need to be able to fund those healthcare expenses. It doesn't just make sense for everybody to be in an HSA if HSAs are available. Yes, they are, you'll hear triple tax advantage and they're
Fantastic
amazing.
tools.
You can deduct it on the way in, it gets tax-free growth, and then you can deduct it, and then it's tax-free on the way out if it's qualified medical. I get it. I understand. That's great. But you need to have the cash flow to support it. And that's the only caveat that I would say there is it has to make sense for you to be in a high deductible health plan in the first place, which is a kind of, you're younger-ish, or at least not using insurance or don't plan to in the near future. You might be in your 40s or so, but you're super healthy.
But again, like if you are younger, but you're engaged in rugby regularly.
Yeah, it's a question.
It may be less.
Yeah, we can do some math and think about what you expect your average year to be in terms of medical bills and see if an HSA actually does make sense.
Correct.
And if you can afford it, really. Right? Like
I think it's a good qualifier.
If your cash flow can substantiate it. But I generally speaking, though, like if you're just like feet to the fires, it's good advice. I think it's pretty reasonable.
All right, buy funds, not stocks.
I love it with a caveat that I would go with ETFs instead of mutual funds. Because of their trading efficiency and their lack of pass-through for capital gains.
Yes.
So also intraday trading versus only end of day. So mutual funds will settle at the end of the day. So like if I want to, I don't know, well, markets aren't open at 8 a.m. our time, but 30. So
go ahead.
Sorry, Rachel's not happy with me.
No.
We're in the weeds.
But you do, I think this is a conversation that's actually come up quite a bit with our clients. In discussing kind of the comparisons, and while similar, there's definitely optimization.
The gist of it, though, is, hey, go ahead and buy V or VTI. Buy an S&P ticker or a total U.S. market ticker instead of NVIDIA or Apple or Microsoft or whatever stock. wholeheartedly agree with this. Could not agree more enthusiastically. Like, absolutely true. Yes, that's amazing. I think it's not almost nonsensical to invest in individual stocks unless you can afford to lose it and you're just enjoying yourself, right?
Okay. What about this one? Stay out of credit card debt at all costs and do not get talked into permanent life insurance.
Yes. Let's go.
All of it.
I am all. This is great. Yeah,
Yes.
absolutely. I would try to take personal loans, short-term loans from family members before that,
Yeah.
and please talk to financial professionals that are not incentivized by the product they're selling you. So fiduciary advisors, and even then you have to be careful because
Some
there's
people,
very little teeth on the enforcement of what you
yeah,
can say. So talk to somebody you trust. Ask for referrals. Ask your friends who they
yeah,
talk to in the spot. Talk to somebody that's not incentivized by product sales. That might be just doing a one-time consulting fee.
and if you're comfortable reading fine print, like the ADVs have to be public on
Correct.
websites.
Yes,
So
absolutely. Read their ADV.
yeah,
Which that's a document that firms have to submit to indicate how they're charging clients.
exactly.
You can see from that if they're fee only or
Yeah.
fee based
Yes.
or
Because they like to obscure it or use a lot of lingo very quickly that I think is intended to
Right.
obfuscate kind of what's happening.
Right.
And then the last one that was on that thread was if you can afford cigarettes, you can afford to start investing.
Absolutely. I think the point there has nothing to do with cigarettes, right?
It
But
doesn't.
everything to do with the fact that if you have disposable income,
It's choices.
right, it's all about priorities, and
Yeah.
some of that should be relegated to investing.
Yeah.
You should actually section off a portion of your income to investing, or your future self will regret it. I think that's very sensible advice.
I agree. I like that one. And again, like the thread is still ongoing. There may be some really great ones. I tried to pull the ones that were either most commonly discussed or ones that actually had just like points for us to actually have discussions about. But so yeah,
That's good. That was fun.
it was good.
Hopefully that was informative. Hopefully that was helpful.
Yeah. And if you have any advice that you feel you would have benefited from
I like that.
years ago,
That's a good prompt.
it is a great prompt. I got really excited when I saw it.
What's yours? Put on the spot.
Oh gosh. Oh God,
Younger self financial advice that would have benefited you today.
so I definitely had the benefit of having two parents who were very into all of the financial things. And so between that and other family members who were really comfortable investing, they definitely had set up like had gotten bonds. I had gotten a bunch of different investments in my name as gifts. So it wasn't that I wasn't investing. I think I didn't fully have an appreciation for that at the time, though.
Yeah, that's fair.
But I didn't access the funds, so it was forced appreciation. I do
That's fair.
appreciate that. What about you?
We went in my younger years. I went all Roth IRAs almost immediately.
Yeah,
So I understood
did do that.
and I understood indexing. So like buy VO and chill.
I remember that.
So we were on track there. I
Yeah.
think if I'm looking to do something differently, it's probably more participation and seeking out professions that are going to have employer plans and then actively participate in those employer plans immediately.
So that's a really good one. I think that oftentimes especially when you're younger and you're going and looking for a job, the price tag is the thing that we understand and can quantify the most.
That's a good point. Yeah. So you want to really, I didn't have a good sense of what total compensation really meant at the
Yes.
time. So if I'm talking a gross salary of, I
Correct.
don't know, 80K, you're like, ooh, great, I'm making 80K.
Correct.
But if you don't have health insurance and you don't
Correct.
have
401k,
or any kind of
PTO
employer
stuff.
contribution.
Exactly. All of that. And I think that it's really hard when you're just entering the workforce to understand the value of some of these things that aren't necessarily quantifiable.
And then at least they're not done for you. And
They're certainly not done for you. Correct.
Right.
So yes, if you are young and you are looking to enter the workforce or you're
Right.
looking to change jobs, definitely feel free to talk to the informed people in your life. You can always shoot us an email. But yes, I think that is a critical thing that both of us probably could have been at.
I agree.
Awesome. Well, until next time.
All righty. Thanks, guys.
Bye.